Hey, it's Soleil, and this is episode 125 of the Orange Pill Investor. I'm going to be all over the place today. We talk a little bit about a degenerate trade I made, and which was not in GameStop, amazingly. And I'm going to discuss a little bit of the upside protection that I have built into my MicroStrategy trading, as well as what do I do when the price moves against me. And I say that a little bit ironically because I always want the price to go up, but with MicroStrategy and any stock that can really just go up like a rocket, a lot of us want to gather as much upside as possible. So we view a surge as kind of like losing money, like, oh, I could have gained all of the upside and I didn't because I had this strike on. So I'll talk a little bit about what I do when the stock price goes against me, and the TLDR version of that is absolutely nothing. I just don't do shit. I sit on my hands and I wait for expiration date, but we'll discuss that a little bit more. So I'm not going to mention who sent me this, but I didn't check to see if they want me to name drop them or not. But it was an opportunity to, I guess it's another one of the meme stocks, and it's pumping along with GameStop and AMC and all this other crap. So I don't know if there's anything to this company or not, whether they actually have decent fundamentals. Somebody actually said that GameStop had some positive earnings, so I don't know. They might even be a viable company at this point. I have no idea. I haven't followed them at all. And with all the trade halting, I was kind of like, oh, should I press the trigger on YOLOing something? But they didn't add any high option strikes. So I was kind of like, normally when something pumps, they'll add strikes up to 85 or 100 or something. And they didn't do that. And I wonder if that was psychological and unintentional. But anyway, so I got put onto this stock, and so I just went ahead and picked up 100 shares. Now it's crazy because when they told me about it, the price was only 14 cents, and I was eating. And by the time I got done eating, it was like 30 cents, and I couldn't even. I just kept chasing. I couldn't get a fill, and then it within 30 seconds or a minute of getting my 30-second fill, it was already crashing back down to 25. So I was going to try to get a 30-cent, did I say 30-second fill? A 30-cent fill, and then I was going to be able to get a 14-cent covered call in the option, and I kept chasing it all the way down, and I was only able to get 9 cents, and of course then it pumped back up to 14 again. So this was so fast moving. I mean, I just couldn't even react fast enough, but I'm still fine for now. And I mean, the damn thing cost $30, so this trade literally could not hurt me in any way. So even if FFIE goes to zero, this does not matter at all. This was just for fun. And so if the stock is still at 30 cents by Friday, then I'll just pocket the $9. I'll probably have to pay $1 to close it. I wouldn't let it expire. And so I would keep like $8 off a $30 investment, like 25%. So this was just kind of for fun, but it does show the fundamentals. And I would have been all over this years ago. This was all I did. I just hunted premium. So if I sniffed this out back in the day, I would have bought in way more and sold a bunch of covered calls against it and benefit. If the price does go up to 50 cents or something, I mean, hell, it can go to $1 for all I give a crap. And I'll just dump all of this on Friday. This is not long term. And the other thing is that you can kind of, on these monthlies that I don't like, you can kind of, when it's only a week until expiration, you can treat that contract like a weekly and just say, you know what, I'm going to get into this stock for 1 week and then get out. you know, some people will be more than happy to go out to, I mean, I wonder if they're never going to put July in here. Sometimes once you get past this expiration date, they'll go ahead and fill in the blanks and give you a July as well. So it'll be interesting to see if they do that. But it's kind of annoying that July is not even here because you can't go out to 60 days if you're that type of trader. So this is definitely not a long-term thing. I would never continue to do this, but this was just fun. And so the only other thing I really want to talk about is MicroStrategy, and it is pushing, which is awesome. And however, I've got a 1370 strike for Friday, 1380, and a 1400. And generally, I like to space these out a little bit more. And you know, I would have liked to have had like a 1450 out here, back when the price was 1200. But I just couldn't. I also hate getting less than 1% premium. And so I think I got 1% on this one, and I almost got 1% on this one, but I shaved off, you know, like 0.1% or something off of this one. And that was kind of annoying. So what do I do when the price starts to surge? Do I start getting nervous, like, oh, it's going to breach my strikes? I mean, I feel it, but I literally just do nothing. So the point of me selling these covered calls is so that I can buy them back cheaper. And so if I know that I'm going to get spooked midweek by the price pumping up, I just won't do this at all, because now I sold it for $1,000 and I got to buy it back for $2,000 just because I'm worried that the price is going to rip. So I literally just do nothing. I wait for expiration. If this is still trading for 1,300 at the end of the week, then this will go back down to almost nothing. And if this rips to 2,000, then I'll let 100 shares get called away and I'll pay it off. That's just how it is. All right, and so, but I do have a little bit of a mitigation strategy here. So what I've been doing is I've been buying some of these leaps, and it hasn't worked out yet, but it's not really supposed to unless the price rips up to like 2,000. So this November 15th 3,800 strike was still pretty expensive, but it's, you know, they're $6,000 a pop. And then if you go to options profit calculator, I put in the November 15th, the 3,800 strike, how much I paid for them. And then if you go down here and you find what would happen by the 18th if the price rips to 2,001, then each of those options I could sell for $22,000. So I'd make like 15 on each one. Now, that would still only be about enough to pay, if the price does rip to 2, that's only going to pay for what it's going to cost me to roll one of my 3 covered calls. So I'd probably still have to let 100 shares go, but that would be fine. I mean, doubling up or tripling up on a leaps is more than fine. So that doesn't bother me a bit. So it looks like I would need 3 of these per covered call for it to truly cover me for upside and upside rip. And at the price it is right now, collecting $3,000 a week, I could probably buy one of these every other week. So that is a possible strategy. But one thing that I think is hurting me is because I am so MicroStrategy heavy. One of the things that Tasty Trade does is they will monitor your account for concentration risk. And so if I try to buy like 1 share of MicroStrategy, they let me buy it on margin, no problem. I only have to pay like $600 for it. But if I try to collect, let me just try. if I was going to try to pick up, 100 shares, ain't no way. Account does not have sufficient buying power, and concentration risk failed. So yeah, I don't have enough buying power anyway. But let me just put in something that I should be able to buy. About what, 50 of them? Okay, so this one didn't say concentration risk, but this one says don't have enough buying power. But anyway, the whole point was to show that I do have some concentration risk here. It's not just, do you have the money? So what I may do, though I hate to do it, I want to accumulate MicroStrategy as much as possible, but I may just start accumulating more Tesla. I mean, Tesla to me is a bargain right now as well, so that doesn't truly hurt my feelings. And if MicroStrategy didn't exist, I might just be all in on Tesla. So this might be completely flipped on its head. I am kind of annoyed that the premium on Tesla is not the greatest right now. However, with it being on margin, that takes this thing out of it a little bit. But even so, something with bigger premium on margin is even better. So that's just me rationalizing, really. But it's always going to be better to trade a stock that goes up. And, Tesla's been down of late. And I'm not even saying, oh, it's oversold or blah, blah, blah. The only thing that I'm confident about is 2 years from now, 5 years from now, Tesla will be worth a shitload more than it is now. They're going to get FSD figured out, the robotaxis, humanoid robots, all that crap. Maybe that happens 2 years from now, 5 years, 10 years, whatever. My thesis on Tesla is that it's the only reason it won't be the most valuable company in the world is because they still have MicroStrategy to contend with. So that's why you see those are like, like Mara and Riot are like rounding errors compared to how long I am MicroStrategy and Tesla. So not financial advice. Not saying anyone else should lever up this much and have this much concentration in any one or two assets. But I do have some emergency actions that I could take. So if MicroStrategy was to go south on me, I can go get some cash to cover a margin call. So this is not as YOLO-ish as it may look, and but it's it's pretty damn close. And so anyway, had a little bit of fun with that tiny little penny stock, and just wanted to go over what I do when the price of something starts to go up, and I start feeling the heat of like, oh, it's getting close to my 1370 strike. Yeah, I look at that and I'm like, okay, as much as I would love it to run to 2000 because I would just unload these leaps, that would be awesome. But yeah, it would suck considering I have 1270 or 1370, 1380, and 1400 strikes. But yeah, I literally just do nothing. I wait till expiration, collect every penny of extrinsic value, and then either just let the calls get called away, the shares get called away, or pay to roll them. That's that. All right, that's it for now. Be good, y'all.